Greg, given everything Steve just said, are you going to chase this?
No, I don't think so. I think the comments are pretty valid, but I think a lot of those things are slightly backward-looking. The market's become much more optimistic about a trade deal and potentially tariff rollbacks. So I actually see the risk from trade now more asymmetric and more potentially to the downside, that could disappoint. Similarly with growth, the market, certainly when you look at earnings estimates, is expecting a strong kind of rebound into next year. And for the quarter we've just seen to be the lows in terms of corporate earnings growth. So again, I think the risks to those estimates are on the downside, not the upside.
Interesting. Margie, I'm seeing some others, some other desks saying your bullish markets, raising maybe your year-end target, only a few weeks away, but then worried about rising yields creating a potential market top in Q1. Where's your head?
Well, I think there's very low possibility of interest rates breaking out of that 1.5% to 2.5% for the 10-year. The Fed is clearly, they learned their lesson in 18 by over-tightening. They clearly are on the sidelines, going to be very passive. So I think that makes a very positive backdrop for economic growth to continue. Even if it's only 1.5% or 2%, that's good enough for earnings growth to expand over the next year or two.
And yet, Greg, you've been studying some of the downside risk related to the 2020 elections and Q1 in particular, which is, of course, the quarter where Super Tuesday falls. Are there certain candidates that you believe could provide more of that downside risk to the markets, especially as you look ahead to some of the polling that's out there right now?
Yeah, absolutely. I think the thing which is interesting about next year in terms of the election is some of the breadth between the Democratic field. There's a huge amount of uncertainty, and we heard about Bloomberg potentially entering that race, but there's a huge amount of uncertainty as to who the Democratic candidate could eventually be, and there's a huge gulf in potential policies that could be implemented. So we think there could be a lot of volatility as we hit the Iowa primary at the start of February through to Super Tuesday at the start of March, and we think that could have some big implications for certain tech sectors, things like large cap tech, the healthcare sector. We think these type of sectors could be particularly impacted by any volatility coming around that primary.
Areas that could potentially face more regulation. Is that one of those things that we should be watching for, say, the first 11 months of the year because, you know, the elections aren't until November? Or is this something that really kind of coincides with the primaries and then maybe we'll get a little bit of a break from that volatility before the election?
Yeah, I mean, there's certainly the potential for the election itself to be very volatile, but it really depends on the outcome for the primary. I think if we have someone like Biden or Bloomberg winning those Democratic primaries, then potentially there's much less market risk in the back end of the year. If we have someone like Senator Warren or Sanders doing extremely well in the primaries and taking that nomination, then the gulf in terms of policies between the Democrats and the Republicans looks massive, and the impact for markets could therefore be much more material. So we think that we should be very focused on February and March as the first pocket of volatility, and depending on what happens in that period, that may or may not drive expectations for much more volatility at the back end of the year.
Finally, Margie, it's amazing. This week, we've had reports that a signing of a trade deal would be delayed. Then the Chinese said we've agreed to roll back tariffs. Now the president's saying, no, we haven't. And yet it's really hard to knock the S&P anywhere far away from 3080. Are our nerves becoming deadened to trade headlines?
Yeah, I think trade is really a very minor effect as far as corporate earnings or GDP, you know, 0.1% or something. What's much more important is the underlying economic growth and how U.S. companies are positioned. And they really have, in my opinion, never been positioned better. So I think that the optimists are going to be rewarded over the balance of the year, and the market is going to surprise on the upside in spite of these uncertainties.